Tackle today, Justice Brothers from Tackle Trading, bringing you all the charts, news, and analysis so you can be informed in your trading decisions in just a few minutes. A combination of strong earnings out of the banks and some cooler than expected core CPI numbers has chart development looking as frisky as it has for some times. Matt, I think that is the big story. Big news day, big day in the market today, and a little bit of a different feel, right? We've had rallies up to the 20 three times now. This one has a little different feel than the previous two, doesn't it, Matt?
Well, it has a little bit of a different feel because it's coming off some news stories. Obviously, we've had the inflationary reports the last couple of days. PPI came in flat yesterday. That was a good number. And then you had the CPI report came in today. And although it was in line, I know you're going to talk about a little bit. Market saw it as a reprieve event, gapped up. And then you had the strong start to earnings season that was widely expected, at least I believe it was widely expected outside of tackle trading. But at tackle trading, we were certainly expecting the banks to kickstart earnings
I
on
mean, you were
very
very,
positive note.
very specific. Banks are going to kill it, deal with it. It's already decided, right? And that's what they did.
Yeah,
So,
and the only question I have is I thought it was priced in. Maybe it wasn't completely priced in because the market is showing a little bit of that upward movement in price out of all the banks here today. Goldman did, BlackRock, Bank of America, not Bank of America, but Bank of New York, JP Morgan, Citibank, Wells Fargo. They all had very similar price action here today on gap up situations. Not all of them are running away from the gap. We'll talk about that here in just a moment. But the only thing I'll say here is that right where you're looking at this 594 area is a very important resistance zone. I feel this collection of resistance zone is a little bit more important than the previous few tests. And so the only thing I'd say is technically different here is you got the combination of the 50 right there at 594. You got the 20 right there at 591. This is what you really have to achieve if you're going to get the bulls excited. This is a good reprieve event after that failed breakdown from Monday. You have that as a fake out. That's very good when you're looking at it from a technical perspective, but very good development is not the ultimate confirmation. And that's what the market has to do. I talked about it yesterday and tackled today. 3 steps. Step 1, get through the PPI report, get through the CPI report, get through the kickstart to bank earnings. And then it becomes a technical conversation up here at resistance 594. You break out, you're breaking out of a trend line, you're breaking out of all your shorter duration moving averages. That's why the market the market gapped up because of the bank earnings in the CPI report this morning. The market didn't continue to run because of where it gapped into a very well-known resistance level. At least people that read the tackle trading newsletter over the weekend, a very well-known resistance level.
yeah, listen, it's going to be very interesting to see chart development. I'm looking forward to the lounge with you and Frank today to see, because I have a feeling we might get some chart development that we haven't seen in a while, right? Especially in those other areas of the market where, banks breaking out of resistance potentially, small caps pushing up against resistance levels. The RSP. I mean, we're gonna have we're fighting. We were fighting support 2 days ago, Matt. Now we're fighting resistance.
Welcome to the modern markets.
Yes.
that's that's what happens. That's what happens. We take everything to the extremes. It's all like it's like we're watching. We're living the market version of the Vin Diesel Triple X series. It's all fast. It's all furious all the time. But no, in reality, Mark, you held support, and then you had positive news coming out over the last 24 hours, and the market responded to that. Quite frankly, I felt like the gap down to kind of start the Monday trading sessions was a little bit outlandish. And so I certainly do think that when you're looking at some of these other indexes, they certainly catch your attention because of the overall development. You got this under the reversal type radar. There's no doubt about that. There's a lot of reversals happening in the short term in the market right now that are just coming to some degree of conversation, ultimately coming to that confirmation conversation. But later on tonight in the on our Tackle Trading YouTube channel, I'm going to be teaching the art of the reversal webinar. And so we're going to be doing reversals later on today. It's at 7 p.m. Eastern Standard Time. We're going to have a lot of fun. It's not going to be a long webinar, just about 30, 45 minutes, just talking reversals, going through the steps of reversals, tracking some of those reversals in the market going on right now. And so definitely come join me tonight. We'll talk more about that.
Yeah, listen, looking forward to that, Matt. Let's get to those CPI numbers. When I was talking to you this morning, I thought your analysis was pretty good. The combination of PPI set the stage for the CPI today. PPI numbers were very, very benign, right? And none of this means the inflationary conversation is going away. That's going to be present with us. We're still seeing sticky numbers, still seeing some highest numbers in 6 months, 7 month type things. But the reprieve yesterday on PPI expectations combined with core CPI today set the stage for a little bit of relief of some of the anxiety, didn't it?
Well, yeah, because the market's trying to figure out not just what the inflation is today. We kind of know the score today. We're a little bit concerned about double dip inflation, but and if it was just the CPI report today, I don't think the market would be responding as aggressive as it is. But with the PPI report, pipeline inflation yesterday showing us that there was not a lot of concern going into next month regarding inflation. Well, that kind of set the stage for this month because those expectations were already built into the market. We were expecting a 0.4% increase. We were expecting 2.9%. But what we got was core CPI that came in at 0.2, and the year over year on core came in at 3.2 underneath the expectation. And so even though we saw the bump up from month over month, it did come in line that was expected by the marketplace as these expectations came out about a week ago. And then you got a little bit of a miss. And that's what the core CPI report today was, a little bit of a miss, but in combination with the PPI report, that certainly relieves the market's concerns, specifically on whether or not is the Fed going to have to, pivot back to raising rates. And based on the totality of the inflationary evidence, I don't think this gives the Fed any ammunition to pivot regarding all of a sudden going from reducing a rate environment to now increasing the rate. And so there was a little alleviation today. But was it enough to kickstart that bull conversation in the market? We'll have to wait and see if it breaks out of resistance.
I'm anxious to see these earnings results. Let's get at them.
Which, by the way, is going to be far more important as we start working into earnings season,
And this is
more than
important.
any other conversation we have on
Listen,
the economic side of
if
the
you are
equation.
new to the markets, it's very important to understand the CPI earnings turn. And what I mean by this is that in earnings season, the last CPI report normally coincides with about the start of the earnings season. And then there is no really big, huge macro data for the next 2, 3 weeks. And so at the CPI earnings turn, you kind of leave the macro side of the universe and
You
turn to
do.
the micro. And it's very important to understand that from a narrative perspective. And that's where we're at today, Matt.
It becomes a stock conversation. It becomes a sector. It's always a market conversation, but it becomes more important on the individual stock components. And obviously, sector analysis becomes very important. Let's talk about those banks who did kickstart earnings here today. JP Morgan is the traditional kickstart. And I do believe the market is pleasantly surprised by the bank's earnings here today. But at the end of the day, I also believe that this was expected to occur. The banks, if you read the newsletter over the weekend, the banks were expected to be, not just the banks, but the financial sector itself, the best earnings growth out of all the sectors. And that includes communication, technology. And they certainly did start off on a very positive note with JP Morgan coming in 481. That was a very good beat of 16.75%. Revenue was up 8% year over year. They also beat that. They posted record profits of 54 billion with net income surging over 50% to 14 billion for the quarter. This was a really good report coming out of JP Morgan. Now, from a technical perspective, JP gapped up. And it's testing a really important resistance zone when you're looking at it from a multiple time frame perspective. You're looking at the daily chart and you see that resistance right north of 251. You come over to the weekly chart, you're looking at fighting that all-time high on JP Morgan. You would certainly be looking to get that dialed in with a little bit of bullish high base type technical formation, but a good report with that 16% beat coming out of the EPS side of it. And then obviously net income. Now, Jamie Dimon, as he loves to do, talked about the complexity of the geopolitical environment, the economic environment, but he also highlighted the resilience of the U.S. economy as well. Now, because Jamie Dimon loves to do that. He loves to warn us about all the things that we all have concern about. And so we did talk about the potential risk of that double dip inflationary side of the equation as well. Now, Goldman Sachs, who usually does report a little bit after JP Morgan, they came out today with a pretty decent beat. Nonetheless, they came out with a 31% beat against expectation. Revenue was up close to 11% year over year as well. Trading and investment banking revenues really kind of drove the growth out of that. And Goldman Sachs had a pretty good quarter, quite frankly, with that 31% beat. Very similar to the JP Morgan analysis, quite frankly. Long-term strength in trend, short-term pattern development is needed. You're looking at a multiple time frame breakout, very similar to that of JP Morgan, which typically means we like to get those things dialed in with secondary pattern development. And then BlackRock here today, they had a little bit of a different situation coming into it. They all had that same gap out, same initial gap surge. But with JP Morgan and Goldman Sachs, they got above all those shorter duration moving averages. BlackRock had some problems coming into the earnings. They were selling off fairly aggressively coming into the earnings. The gap up on BlackRock, despite the beats, they came in with a little bit of a beat, just a 1.5% beat. Revenue was up 22% year over year. But when you're comparing the beats on earnings, Goldman comes out with a 31% beat on EPS. JP Morgan comes out with a 16% beat on EPS. BlackRock 1.5, and you gap into the 50 period moving average. If I'm an investor in BlackRock, I'm not, but if I would be, I'd be looking at that as a little bit of an alleviation as well, coming into that 50 period moving average. So it makes some sense to have BlackRock show a little bit of weakness at that 50 period moving average. That is a trend setting moving average, whereas your shorter duration moving averages really work well on from momentum and support and resistance analysis. That 50 is kind of a trend starter. You would certainly be looking at pattern development, but right now I'm looking at a bearish edge here on BlackRock.
Well said, sir. Dollar. This could be an important chart as we take a back seat, Matt. You know, this has had some topping characteristics. We're not puking, but we're stalling. I'll take it. Break it down for us.
Well, you obviously took that in the market as well. A little bit of a reprieve went a long way. We're still looking at the slowing momentum environment that we were looking at yesterday. Haven't really seen any significant changes on the pattern development. Quite frankly, you tried to test under that, but we've seen a couple of tests under the 90 EMA recently, but it held firm against the 20. Same technical conversation. I'm still looking at this as a slowing momentum trend, losing a little bit of steam at the top end.
Yeah, no, and yields taking the biggest hit. Dollar looks benign compared to yields. Yields taking a big move down, one of the biggest moves I've seen in well over a month. And, all of that has commodity charts looking healthy. Gold in particular, Matt, is breaking serve from those surges in the 50 where it surged and puked. It's surging and developing here. It's a pretty good look as we head into that resistance level for the next major technical test.
Yeah, I talked about that increase in support and the importance of that going into a multiple time frame. To me, this is a potential breakout situation, but it would have to break out for a behavioral change. When you're looking at silver, an improving condition off of that increase in support, still rocking that $28 resistance channel, no doubt about that. On the copper side of the equation, it is testing all the way up against the 200, trying to break out of the 200 on a V-shaped recovery. That is, quite frankly, a little bit difficult to chase when you're looking at the copper. Like the development on both gold and silver, we'll see if they can come to a proper conclusion with the breakout.
Well, listen, we got a lot of conversations to have in the lounge. Come join it. We predict markets before they happen all of the time on the lounge. It is something you want to be a part of. Go to tackletrading.com, sign up for that 15-day free trial today.